All right, welcome to the Atlanta Landlord Luncheon. My name is Matt Martin. I'm here with Chris Littleton, one of the owners of PMI Georgia. We're excited to be hosting the Atlanta Landlord Luncheon and have another exciting speaker for you guys this week. But our goal is to bring you monthly education, market updates, and networking events to help buy and hold real estate investors build long-term wealth through real estate. So you're welcome to check us out on Facebook, LinkedIn, and YouTube. You can just Google the Atlanta Landlord Luncheon and it'll show up there. We do have Chip at the Hobnob Tavern every month. So there's a great opportunity for you to come in person and network with us. And we will let you know about other exciting events happening around town, whether it's through the Atlanta RIA or other networking events where you can meet other investors and other people to help build out your team to help you accomplish your goals. So Chris, you want to share a little bit about PMI Georgia and what we do?
Well, PMI Georgia, we are a full service property management. We've helped our clients acquire properties, sell properties off as they're maybe doing 1031 exchange, moving their portfolios around a little bit. But it's been in it for 20 years, and it's been a great opportunity. Made a lot of wealth myself and made a lot of wealth for our clients over these times. A well-managed property will do you good. And one of my favorite acronyms of all times is the real estate's an ideal investment. You got income, you got the depreciation strategy, you got equity that you can get into properties with great equity, sweat equity positions. You get appreciation over time and leverage. I would say leverage is the number one key component of making a property returns greater than you would expect. So I would say, so keep that in mind. Real estate's the ideal investment, and management is the keys to success. So if you're looking for getting into some real estate investing, we'll be happy to evaluate those properties with you, give you a good pro forma on that property, and you'll be in good hands. So.
That's right. So we manage over 450 doors throughout Metro Atlanta, most of which are single-family townhomes. There's also some small multifamily in there, duplex, quadplexes, and above. But if you're getting ready to start your investing journey, or if you have a rental portfolio and you're fed up with trying to manage it yourself, we'd love to talk with you and share about how we can help offload some of those headaches and help get your portfolio performing. And we can also prevent you on the front end from making a lot of really costly mistakes, especially in this time when evictions are still very costly and lengthy. And there's all sorts of new laws that have come up. So we would love to be able to help you with that. And you're welcome to go to our website, pmigeorgia.com, to request a free rental analysis. We also have some other calculators you may be interested in. There's a rent-or-sell calculator. And some other things worth checking out on there. So, but Chip, let me pull you up here. All right.
Hey, Chip Cagle. I'm with Longhorn Investments, and I'm here in Atlanta to serve your needs. But I can actually help you in any of the 10 states where Longhorn lends. What Longhorn does is on the fix and flip loan, we can offer you 100% financing. That's 100% of your purchase and 100% of your rehab budget, as long as the total is less than 70% of the appraised ARV. We can even go up to 75% if you get pre-approved for a rental refinance down the road when you're finished with your renovations. So I can help you with that. My phone number is up at the top of the screen that Matt put up there. So 404-216-5599. Give me a call and we can talk about it. Now, those exciting offers, you'll see that what Matt put up there looks like they expired, but it actually got extended to the end of September, and then you've got until the end of October to close on it. Okay? So you got 2 more weeks, basically. Get your application in within the next 2 weeks, and a little over 2 weeks, and then you got to close by the end of October. But as you can see, we've got 2 things going on. The first is the fast track to loyalty. So that's where somebody who's done 3 renovations before can go straight into our loyalty program. I can help you with that. Make sure that you qualify for it. The other thing is you can choose to have either a lower half point or a lower percent, of your interest rate. Where that would come into play is the 6-month mark. If it's going to take you less than 6 months, then you'd be better off picking the points. And if it's going to take you more than 6 months, you'd be better off with the interest rate, because 1% is an annual number. And if you take 6 months of that, that's a 0.5%, which compares evenly to the 0.5 point. All right, so the other thing you may see on the screen there is it says from Memorial Day to Labor Day, I'll give you a $100 gift card to Longhorn Steakhouse. Now, we're not associated with Longhorn Steakhouse, it's just the same great name. And that's been extended to Halloween. If you get a loan with me between now and Halloween, then if you close on it, then you'll get that $100 gift card. The last thing on there is referrals. I do referrals. So it's at least $500, but if your loan amount, if the person you referred me's loan amount on the first loan is $200,000, more than $200,000, then you'll get a quarter of a point. So you see there that it says $300,000 would be $750, up to $1 million one would be $2,500. That's it, guys.
All right. Thank you, Chip. Now I'm going to introduce our speaker for today. So I'm going to pull you out, Chip, and start adding Roger in. I'm going to welcome Roger to the stage. So our topic for this month is how to reduce your tax bill before the end of the year. So Roger's going to share with us some proven strategies for real estate investors. So I'll introduce Roger. So he's a Main Street certified tax advisor. He's the founder and CEO of Investors Accounting, LLC. He's a 1991 graduate of the Citadel, the Military College of South Carolina. And upon graduation, Roger was commissioned as an officer in the U.S. Army Reserve, where he served for 8 years. During his time in the reserves, Roger also built a successful career in corporate America, holding positions ranging from staff accountant to chief financial officer. He founded what would become Investors Accounting in 1999 and went into full-time practice in 2002. And we're really excited to have him share. We're entering the final quarter of the year in just a couple weeks. And so this is a great time to be brushing up and thinking about our tax strategies before the year is over and the tax bill comes due. So Roger, thank you so much for joining us, and I'll let you take it away. Oh, we got you muted here. Let me try. I think your mic is muted on your end.
How's that?
Still muted.
There we go.
There we go.
All right.
Hey,
Awesome.
everybody.
Welcome.
Sorry about that.
That's all right.
How's everybody today? Glad to be here with you. Yeah, I'm Roger Herring, and I'm in my 24th year of full-time practice. I founded a little company called Investors Accounting, and our name's what we do. We primarily work with real estate investors, whether you are a landlord, a property manager, flipper, wholesaler, agent, broker, anybody that can qualify as a real estate pro with the IRS. That's who we serve. And I'm really excited to talk with you today because what can I do to cut my taxes right now? Well, today I'm going to give you the answer. And we're going to start with things that everybody can do and work through right to the end. People that have huge incomes or may have blown up a 1031 and have this huge capital gain that they have to deal with. Today, I'm going to teach you about how to do it. So if you will bring up the slides there. All right. And yes, it is working. Now, here is my disclaimer. The information provided in this seminar is for educational purposes only and does not constitute legal, tax, or financial advice. No offer or solicitation for the sale of securities or other financial products is being made. Unless you are already a client of this firm, no client relationship is created by your attendance or participation in this seminar. If you are an existing client, please do not act on any information discussed today without consulting with me directly to ensure it aligns with your personal circumstances and objectives. In other words, folks, don't do anything I say, because everything depends on facts and circumstances. You need to check that out with your tax advisor. And if you don't have one, well, yes, we are taking clients. So, my credentials. I am an MSCTA. I was one of the first to get that designation in the country. That is a tax strategy certification, and it's done through Mr. Mark Kohler's organization. You might follow him online. You can Google his name and find out that he mentors thousands upon thousands of CPAs, accountants, and tax attorneys across the country. I have been doing accounting and tax for 35 years. I'm in my 24th year of full-time practice, and I am an accredited investor. So if you ask me questions, I should be able to give you at least a B+ answer. I am a published author since 2009. These are two of my three latest, or that's one of my three latest ebooks that you can download. And you can go to theinvestorsaccountant.com and link over to that. And if you're on that site, you can also schedule a discovery call to find out how we do things. Now, I was first published back in 2009 in the Congressional Record of all places. You guys know how sometimes you'll go out and Google your name? Well, I'd written a white paper, and all of a sudden my name popped up and it said Congressional Record. I'm like, what's going on? The white paper was about a bill going through Congress that was going to do some very nasty stuff to the S Corporation. And there's my paper written into the Congressional Record. I'm like, oh my word, they know who I am. Not a good thing, but it is a good thing. So a little bit about us. Obviously, I founded the company in 1999. We started specializing in real estate in 2005. In 2016, the practice went to total real estate focus. Then in 2021, we added high incomers. Now, our clients range from individuals in pre-acquisition to multi-million-dollar ventures to highly compensated professionals like lawyers and doctors that also have portfolios or are looking to build portfolios. Now, I ask this question all the time. There's only three reasons you pay taxes. You know what they are? You made money, you did something dumb, or you did both. That's it. Three reasons. Most people make money. Some people do something dumb, but they don't even know they're doing something dumb. And if you do both, it hurts. I ask people, how do you pay the least amount of tax? And I used to say, don't make any money. Now I say, don't look like you made any money. Okay. Oh, I meant to answer, guys, if you got a question and want to ask something, go right ahead. I got no problem with that. So
yeah, absolutely. And people can also leave a question in the comments below this feed too, as well. So,
all right. So today we're going to learn how to kill income. And we're going to talk about strategies first that anybody can use, whether you're a real estate investor or not, whether you're a business owner or not. Then we're going to talk about business owners that would include what? Flippers, wholesalers, real estate agents, property managers, any type of business. And some of these strategies that we're going to talk about here work for real estate investors as well in certain cases. Then we're going to talk about real estate investors, specifically landlords. Then we'll talk about two things: advanced strategies for people that have high income. It could come from a high income W-2. It could come from large capital gains. It could come from your business had a heck of a year. Okay, I'm going to show you how to do something about that without hurting your ability to borrow money, meaning I'm not creating a loss that the bank will hold against you. Okay, so let's talk about things that anybody can play with. Okay, the first thing is retirement strategies. It blows my mind how many people that have an ordinary income stream and don't use retirement strategies, especially people like landlords and flippers and wholesalers. because that solo 401k being self-directed, you can buy property with it. Guess what? You can do subject twos with it. This is a great way to shelter income and to get a deduction if you need it, or to put it into Roth. What you have here, 401k, anybody that has a regular W-2 job, under 50, 50 plus. Same thing for a solo K, but look at this. If you're an S Corp, under 50, 50 plus, plus 25% of your W-2 you can put in there. That's a lot of money. A SEP, you can put up to 25% of your income. Your IRA, as long as you have ordinary income, you can put 7,000 or 8,000 in there. And the same limits on Roth. Now, a lot of people say, but Roger, I make too much money for a Roth IRA. No, you don't, because there's a back door. You see, the law that surrounds Roth IRA is related to contributions. If you make over a certain amount, you can't contribute to a Roth, but you most certainly can convert from traditional to Roth. So the way the back door works is I'm going to make an after-tax, non-deductible contribution to my traditional IRA, and then I'm going to immediately convert it to Roth. And now I have money in Roth. It's a pretty nice little trick. Now, there are some requirements. You can't have other traditional IRAs, things like that, shut the back door. That's why I said, talk to your tax advisor and make sure it works for you. Now, anybody can have a health savings account. Anybody. A single person can deduct $4,300 a year. A married couple, a family plan, you can deduct $8,650. It is fully deductible no matter your income level. All you really have to do is have an insurance policy for your health insurance that qualifies for the HSA. And what a lot of people don't realize is you can self-direct, but Roger, I work for somebody else. I'm a W-2 employee. It doesn't matter. You don't have to take their HSA. All you have to do is have a qualifying health plan. You can have your HSA with any of the self-directing firms that's out there. And here's the beautiful thing. This is really just a deductible Roth IRA. And I'm going to teach you a trick. Let's say you're healthy and you don't really ever spend anything. Still do this. Why do you want to do this? Because you can start collecting receipts now. I have clients that have over $250,000 in HSAs because they've never reimbursed themselves. They've paid all their medical out of pocket. When they want to draw, what do? They turn in the receipts, because this is not like your cafeteria plan where you have to turn everything in by the end of the year. You can hold these as long as you want to, 10, 20 years, as long as the HSA is there. You turn in the receipts, you get reimbursed tax-free. That's pretty cool. Oh, and you can self-direct it. I think I said that. You can buy rental property with this. I have a acquaintance that bought cattle for a ranch with this. It's pretty cool. Investments. If you're going to have capital gains and you have a portfolio in the market, you want to do something called tax loss harvesting. What that means is you're going to go through your portfolio and you're going to sell dogs, and you're going to create a loss that is going to offset the capital gain. And guess what? You can do the same thing with crypto, but crypto has a unique ability. Let's say that today crypto falls to where I've got a $40,000 loss. And I know it's going to come back, but you know what I can do? I can immediately sell the crypto and buy it right back. And now I have harvested a $40,000 loss. You see, I can't do that with securities, because securities have this thing called a wash sale rule. That means that if I sell it and I buy it back within 30 days, the loss doesn't count. There is no wash sale for crypto. You want to avoid these things called capital gain distributions. You know how you'll get a 1099 for your dividends and it'll have this huge number of capital gain distributions. What happens is when you invest in a mutual fund, they're buying and selling. Well, every time they buy, there's a capital gain or there's a capital loss. And that gets passed through to you usually as a capital gain distribution. But if you invest through ETFs and indexes, you're not going to have that problem. Municipal bonds are also a great way to avoid both federal and state taxes in some cases. Now, these are things anybody can do. Charitable contributions, bunching, and appreciated assets. Let's start with appreciated assets. Let's say that you decide to donate some stock. You get to donate the stock at fair market value, and you don't have to take the capital gain. You just sign the stock over to the charity. Bunching is a strategy for itemized deductions. Let's say you had a pretty good year and it's coming to the end of the year and you're about to write a check to a couple of nonprofits, but you want to spread it out, but you want the deduction right now. Well, you know what? You can bunch those deductions, and instead of making it on 12/31, make whatever you were going to do for 2025 on January 1 and move it to next year, and then do your regular contributions. What we're doing is we're combining 2 years of deductions into one thing, into one gift. In Georgia, we have these things called charitable credits, and anybody can do this. You can go online to the state of Georgia. There's the Georgia Peach. There's the Georgia Goal, the Georgia Heart, Foster Children Network. These things, if you owe state taxes, these just make sense, because what happens is for every dollar that you donate to these programs, you get a state credit. That's a dollar for dollar offset on your state income tax, and you get a federal charitable contribution. You can go online and you can find these. If you look up Georgia Goal or Georgia Heart, Georgia Goal is a scholarship program. Georgia Heart is a rural hospital program. And Georgia Foster Children obviously supports the foster children. Now, I'm going to go ahead and tell you, Georgia Goal was filled up for 2025 in February. Okay? But Heart and foster children still wide open last time I looked. So you can still get tax credits for 2025. And SALT, state and local taxes have changed. We've been stuck with a $10,000 limit since 2018. That has now gone to $40,000. Now, if your income is $500,000 or greater, then that starts getting phased out. And we'll talk about what to do about that in a few minutes, especially if you own a business. All right, guys, before I move into business strategies, was there anything that you wanted to ask or anybody put in?
No, that was great. I learned some new things there.
All right. Let's move into business strategies then. First off, please make an S election. This is especially for new investors, new businesses that have ordinary income. If you have ordinary income and are making at least a net of $50,000, you want an S election. The S election is how we avoid this nasty thing called self-employment tax. So I'm going to use an example real quick. I make $100,000. If I don't have an S election, I pay income tax plus $15,300 self-employment tax. I do the same thing as an S corp, but now I can employ myself and I'm going to pay myself $40,000. The self-employment, which is now called payroll, is only on the 40 grand. That comes into 6,000 and some change. So I'm saving $9,000 by doing this one thing. Now, if you are a landlord, thou shalt not ever make an S election, because the worst places to have rental property are in an S Corp or a C Corp, you don't ever do that. Okay. That's a whole different ballgame though. We won't talk any more about that right now. How about pay your children, guys? As a landlord or any of the other professions, there is a way to pay your kids. And if you do it right, you can pay each child that $15,750. There will be no federal income tax, no Social Security, no Medicare. State, yeah, you got to pay a little bit of state tax on it, but you get to write it off in full. And like I said, you got to do it right. Because if you operate out of an S Corp, there's a right way to do it and a wrong way to do it. If you do it the wrong way, you're going to pay all those taxes I just talked about. Okay? But here's the deal. This is for a child under 18 years old. You don't have to issue them a W-2. You don't have to issue them a 1099. And now that they've got earned income, they can have a Roth IRA to save for college. You can self-direct it. It's a pretty cool deal. Now, that was the molasses. Here's the salt. You can't just give the kid 15 grand. Okay? The kid has to earn it. But kids know more about social media and online than we do. My youngest son has been managing my social media since he was like 13 years old. Okay. They know more than we do. You can find a way to pay your child, even if your child is about that long and still in diapers and keeps you awake all night. You can pay a modeling fee. There are strategies. And if you go to my website, which I mentioned, theinvestorsaccountant.com, there's a link over to my YouTube channel where all these strategies I'm talking about today are laid out for you. The Augusta rule. This is free money. The Augusta rule is based on the Masters Golf Tournament. People wanted to be able to rent their property and not pay taxes on it. So we can rent our property up to 14 days, not taxable to us. But Roger, I don't want a stranger in my house. I don't want one either. Who am I going to rent to? My LLC. And I'm going to have meetings and I'm going to have gatherings. The way I use the Augusta rule is my employees meet at my home and we have training 14 times a year. We sit around the table or we sit around the big screen and we watch real estate symposiums. We do the training. I get to pay myself a rent. The company gets to write it off. I don't have to claim it. Last year, I got about $12,000 doing it this way. Now, I have employees. So people without employees, the rules are a little bit different. But guys, this is free money. This is free money. And obviously now that we have the One Big Beautiful Bill Act, we now have 100% bonus depreciation, and that is in perpetuity, meaning forever or until we wind up having the law changed on us. But right now, if it is less than a 20-year life, which is just about anything other than real estate, you can use 100% bonus depreciation and write it off up front. That is a pretty sweet deal. So buy the computers, buy the big electronic whiteboard, buy the office furniture. For that matter, buy the car. Buy the car because now the SUV deduction is full power again. But let me explain to you how this works, okay? Guys, first off, it has to be over 6,000 pounds. If it's not 6,000 pounds, then I think the limit's $23,000 is the max you can take on it as bonus. But if it's over 6,000, yeah, you can write 100% off depending on the business use of the vehicle. So how does that work? Business use of the vehicle simply means how many miles do you drive it for business? Oh, well, between my flipping and my rental properties, I drive it 100% of the time. Here's the problem. Flipping and the rental properties ought to be in two different companies because they're taxed totally differently. So you can buy the SUV in your name, The IRS doesn't give a rip whose name it is. They care about business use. But I got to have this vehicle where I'm going to have it at least 50% or more use. So wherever you drive it the most, and hopefully that's in the flipping company or the ordinary income company, because what you can do, in all due respect to property managers out there, you can make your S corporation manage your rental properties and then drive the vehicle in the S corporation when you go to the rental properties. That's going to increase the business uses of the vehicle. Or you can go and buy that vehicle and take delivery the last day of the year. Drive it home and park it. You now have 100% business use. In the future, as long as that use does not drop below 50%, there's no recapture on it. Okay? That's the molasses. Here's the sulfur. If you have 50% business use and you bought a car for $60,000, your write-off is $30,000. Here's more sulfur. If you sell it or trade it in, whatever you sell it for or the trade-in allowance is taxed as ordinary income. They treat that as recapture depreciation. Okay? But if I need the deduction now, do it. There's some state elections we can make relating to salt tax. Here in Georgia, we still have the option to pay our taxes at S Corp or partnership level instead of having them flow through where there is the limit. So if your AGI will be over $500,000 or you have at least $40,000 in salt taxes with your business, consider making this election and paying them at entity level. Now, if you're a real estate pro and you've got all kinds of passive losses that you're able to write off, think twice before you do this. Okay? This is one of those things, like I said, you need to talk to your advisor. Now, this is a landlord luncheon. Let's talk about rental. I love rental. First off, are you a pro? If you're a pro, you've got 750 hours minimum. You've got more than half of your for-profit time, and you materially participate on all your properties. Material participation is different from the 750, but it can include the 750. You see, 750, you as the pro must have that on your own. Material participation, if you're married, your wife's time counts too, or your husband's time counts too. So this is a combination. Material participation is a combination of spouses. The 750 hours must be attained individually. How do we do this? The most common way is we make an election that treats all rental activities as one business. And I got to have 500 hours. But the IRS is throwing a monkey wrench at us. Okay? If you have a mix of short-term and long-term properties, you now must prove material participation separately. So you have to have the material participation on the long-term and the material participation on the short-term. Now, if you've only got one short-term rental, there's an easy way to do that. It's not included when you aggregate properties. Instead, you would have 500 hours across all your long terms. And on that one short term, you only need 100 hours, as long as no other single person has more time than you. You're good to go. Now, for those that don't qualify pro, you still may be able to deduct. It's called the short-term rental loophole. This is available to anyone, regardless of pro status. Here's how it works. The average stay has to be 7 days or less. And unlike regular long-term rental that you only have to have a be ready, meaning it's advertised, or excuse me, ready, meaning move-in ready, and advertised, meaning it's available, you have to actually have 2 stays by 2 different guests before the last day of the year. No services during their visit. material participation, 100 hours material participation, and this includes spouse time. If you're married, no other person can have more time than you. So what do we get to do? If you do this, this opens up full deductibility for the year on the property, just like you were a real estate pro, full deductibility. And then we can do this wonderful thing called a cost segregation. Cost segregation is literally the ultimate depreciation strategy, because what it does is it breaks a 27.5 year or a 39-year asset into 5, 7, and 15 years. It breaks the components out to where only the structure itself is depreciated over that long period. And with 100% bonus depreciation, if you bought it after the 19th day of January 2025, you can use 100% bonus depreciation. Okay. So let's say that I bought a property for $550,000. $50,000 of that we determine is land. So I have an improved value of $500,000. I use 20% as a planning figure. 20% of 500 means I get a $100,000 additional depreciation write-off. And if I'm a pro or I have the short-term rental loophole in effect, to the extent that I create loss, I can deduct it against my ordinary income. Pretty cool. Well, Roger, I didn't buy anything this year. I bought my properties in 2018. Not a problem. We can do a cost seg in the past, and we get the law that was in place in the past, which in 2018 was 100% bonus depreciation, and we can take it all in 2025. If you bought something in 23, that's 80%. If you bought it in 24, it's 60. You have the law that was in place. They didn't change the limits for those 2 years. Oh, and the IRS regs have changed on a cost seg. Used to have to tell people that if you 1031 the property, then it's all going to get recaptured as ordinary income. If you sell the property, nothing's changed. Anything that was cost seg will get recaptured as ordinary income. But now, if the part that was segged is part of the structure and the state deems it to be part of the real estate, then the IRS will treat it as real estate for purposes of 1031. So what that means is if I have a house that they have called out the plumbing and I've taken a write-off in my original cost seg, under the old rules, I would have to recapture that if I did a 1031. I no longer don't because it's a part of the structure. Now, however, let's say that I put in a pool and the pool would be a land improvement, but any plumbing I had to run to the pool is specialized. That doesn't count. So I've actually got an entire spreadsheet that explains, okay, what happens when. Send me a message through theinvestorsaccountant.com. I'll be happy to share it with you.
Roger, do you recommend cost segregations on long-term rentals, or does it just make sense for short-term and commercial?
No, it makes sense on long-term as well, because now everything is done with algorithms and photographs and information. The company that I refer to, my clients are paying less than $700 per property.
Wow.
So when you get a huge honking write-off, now I would not recommend it for anything that has an improved value less than $100,000, unless, of course, you are doing multiple properties. I had a client last year, had a tax issue, and most of his properties were $80,000 properties, but he had over 100. We cost segged every single one of them. So it's an option.
Yeah.
Yeah. You used to, if it was still $3,000 a pop, I would say no. But now for $700, I can get a $7,000 tax benefit. You better believe I'm jumping on it.
Yeah, absolutely.
Now we're going to get into something advanced. Okay. This is when somebody has big income. How did it come? It could be your W-2. I've done this with doctors and lawyers. It could be you sold a business and have a huge capital gain. I just did a scenario for that. It could be you just had a really good year flipping properties and you got all kinds of income. Or you could be like my client that had 3 1031s blow up on her at the end of the year. And now she's stuck with a capital gain coming into this year. I'm going to show you how we deal with them. Okay. First thing that we're going to do is we're going to attack adjusted gross income. That's above the line. Okay. There are 3 ways we can do this. Okay. Actually, there's about 100 different ways. These are 3 of the ones that are the most common. A leverage business opportunity that I will explain. A solar passive ITC, that's an investment tax credit, which is great for landlords that are real estate pros and your properties are producing income instead of phantom loss. And then there's the old standby oil and gas. Leverage business opportunity. What these are, this is a bonus depreciation play. And what we're doing is essentially buying into a system and creating a business that we can take bonus depreciation. This can be done with software licenses, with equipment. That's my favorite way to do it. You can do it with films. You can do it with foreign currency. Okay. The objectives, obviously, I just said bonus depreciation and ROI on the back end. And when using bonus depreciation, we're knocking down income without damaging your ability to borrow money with the bank because they're going to add it right back. Okay. So this is how it works. I call this the wheel. We're going to set up a business and we're going to buy an asset. Now, this doesn't mean you have to go find the asset. The programs already have everything for you. Okay. This doesn't mean you are going to go out and spend tons of hours. All you need is 100 hours for material participation. You're going to put a down payment. In this example, we put down $100,000 and I'm signing a note for $500,000. It's a soft pull on your credit. And the note is in the new LLC that you create, so it's not hurting your borrowing ability. Now, we're going to place this asset into service, and it immediately goes into an established rental program. Between you and your spouse, you have to materially participate. That means 100 hours. And for doing that, you're now getting $600,000 of bonus depreciation. So the multiplier on this, you put in 1, you're getting 6. This is a 1 to 6 program. I have them from 1 to 3 to 1 to 10. Each month, you're going to collect a monthly note payment. You're going to pay the note, and you'll have a monthly ROI. And people ask me, what if my equipment or my stuff is not rented that month? It comes from the pool of the class. So you're getting this money every single month. At the end, the asset is sold. The note is paid off. You have an ROI. But now we're going to recapture $600,000. What do? We do it again, but we can do it for a lower investment. And we can run the wheel again and take it down to nothing. Or we can use another method. Okay? That's how a leveraged business opportunity works. Solar passive ITC. These, like I said, are great for real estate pros that have passive income and we need to get rid of. Because I'm going to use 100,000 as an example. It's a nice round number. I get 30% of that as an investment tax credit. So that's a $30,000 credit immediately. Bonus depreciation. I get bonus depreciation on my entire investment. So I've got a $30,000 credit and a $100,000 bonus depreciation deduction. Going forward, I've got passive income from the sale of electricity. Now, this is not you going out and creating a solar farm. This is you investing in a solar fund. Now, the only bad thing about this is we've only got till the summer of 2027 because the One Big Beautiful Bill Act cut the time frame. This was going until 2030. Now it has until July 2027. Okay. And then there's direct oil and gas. Guys, this is vanilla. Some people like strawberries, some people like vanilla. They would rather invest $100,000 than give it to the IRS. So if I put in $100,000, I get $80,000 immediately in tax write-off. The remainder is depreciated over 7 years. And when the well comes in, I've got an ROI on the back end. These are ways that we attack above the line. This is going after adjusted gross income. But once again, these are either tax credits or depreciation, which the bank is not going to care about. Now, once we've attacked above the line, if we still need to, we can attack below the line. That means with charitable programs. Here's the thing we have to remember. Always attack above the line first, because while $1 of bonus depreciation can offset $1 of AGI, charitable contributions are limited from 20 to 60%, depending on what it is. So first thing I'm going to tell you about is the easiest one. And guys, anybody can do this. Donor advised fund. Let's say that I've got a whole lot of money right now. I need a big write-off, and I'm going to give over several years. You can go to really any of the big brokerage houses and set up a donor advised fund. What that means is I can put a large amount of money in 2025, and I direct over the next several years where that money is going. I get my write-off right now when I need it. I'm still being charitable, and that money that's in the donor advised fund, it's growing because it's whatever you haven't sent out, it's being invested. So that money is going to continue to grow. This is a very effective and very simple strategy. Now, I'm going to teach you two very different strategies. One, I don't want you ever to do because the IRS will eat you alive. The other is similar but totally different. Leverage donation. I want you to think conservation easement, where you're buying into somebody else's land. It's an alternative asset, and it relies on a subjective appraisal of the value of the land. This is under heavy IRS scrutiny right now. They're also called fee simple donations. Stay away from these. Okay. I had a client come to me a few months ago and said, this guy was telling me about a comic book thing. And I'm like, what? He said, yeah, you buy all these comic books and have them appraised and then donate it to this kids group at the fair market value. I said, yeah, wake up and smell the audit. Let's not do that. A different way of doing this that I absolutely love, it's similar, but it does not rely on an alternative asset. Okay. Instead, we do a tax equity strategy that has a donation option. And what we're using is something like a software license. The manufacturer makes and sells, and they have a fair market value that is determined by what? The marketplace. What it's normally sold for. Okay. So the manufacturer puts a number of licenses into an LLC. You buy into the LLC, and this gives you about a 4-to-1 write-off because you vote whether or not to donate or to sell the software licenses yourself. This is a much stronger strategy because there is nothing subjective about the value. Okay. Case study. Michael and Sarah, $1 million capital gain because they sold their business. 2025, they would have owed $238,000 federal. We used to leverage a business. They put in $160,000. Their tax savings was $238,000. We killed it. And this investment is going to have a return on investment. Somebody that has high income, in this case, it was a doctor, 2.3 million W-2. That could be a $2.3 million business owner. His estimated liability, we use the same strategy. Notice his tax savings are more because the previous one was a capital gain. This is ordinary income. These are pretty valuable tools. People ask me all the time, how much income do you need? 400,000. If you're going to do an advanced strategy, you need at least 400,000. Minimum investment, it depends. The lowest program is 40. Do you have to be an accredited investor? Sometimes, yes. I prefer you be an accredited investor. What is an accredited investor? $1 million net worth, excluding your primary residence, or if you're married for the past 2 years, you have AGI of $350K, $200K if you're single. What's the risk? The biggest risk is you. People not doing what they're supposed to do in a timely manner. Congress can always change the law, and the markets can always change. It won't hurt your borrowing ability. Yeah, we've got a referral program. Now, a lot of people want to know, how can they reach out to me? Okay, here's how we do things. You got a free discovery call, and you can book here at theinvestorsaccountant.com. There are 2 levels of where we go after that. A CTC, it's a comprehensive tax consult, is $1,750. We review 3 years of financial statements, 3 years of tax returns, your personal financial statement, ask you a whole lot of questions, and we come up with an individual tax plan for you. And that's before we even talk about you becoming our client. The ATP is for people that are going on the advanced track. The $3,000 includes a CTC, but then we have an AI analysis on your taxes. We create a pro forma tax return based on where we think you're going to be this year. We send that through AI analysis. We come up with multiple ways of saving money. And then we have what's called a planning conference where I present to you what you can do and what the strategies are. In all cases, you get a full written write-up, and whether you stay with us or not, you've got the write-up. So I think that's everything I have. I would love to answer any questions anyone has.
Well, Roger, I'm sold, man. Sign me up. That was great.
That's a lot. That's a lot to take in. So
it is a lot to take
great
in.
Job.
I'm doing this exact same presentation on October 1st. This was kind of a run through for it. We're doing a lunch and learn. I'm going to do the same thing.
Awesome.
All right.
Yeah, great. That was a great deep dive on a lot of different things. I was familiar with some of those things, have heard a few, but I really, I learned a lot on this. So yeah, I'm definitely interested. We talk all the time with investors about the tax advantages to owning real estate and things like that. And I think most people, especially right now, the majority of our leads are what we call accidental landlords. They had a great low interest loan and they relocated, and so they're hanging on to that rental property. Or maybe, they bought in 2022, 2023, can't quite sell for what they want, so they want to hang on to it. And there are a lot of advantages to owning that, even in taking paper losses that people just don't quite understand. But there is a lot of work to be able to get those incentives and understand how it works. So
yeah, Chip, they call it passive income and passive loss, but there is nothing passive about it. You're going to work your butt off.
Right. Chip, you got any final comments for us before we sign off?
No, Matt, have you come up with what we're going to have next month?
No, we need to have our planning team get together on that one.
So that'll
But
be October 20th,
okay,
the third Monday in October. It's always the third Monday, almost always. We did have one time where there was a holiday, we changed it.
right.
Yeah, October 20th. So we'll have to come together and try to figure out what we're going to do next month. But
And for those of you still watching, you're welcome to come meet us at the Atlanta RIA meetings, which is the second Monday of the month. I'm always there. Chip is usually there. We'd love to connect with you in person. And otherwise, we will see you guys next time at the Hobnob Tavern and online. And Roger, thank you so much for joining us today. It was very insightful.
Thanks again, Roger. Have a good day.